Welcome to Value Vest Daily. Today we are diving deep into Hims and Hers Health, a company that's been on an absolutely incredible run. But, with any stock that shoots for the moon this fast, the big question is always, can it last? We're going to break down the bull case for 2026 and see if this incredible growth story really has the legs to keep on running.
Right, so this is the million-dollar question, isn't it? We're going to dig into the numbers, the strategy, and really get to the bottom of the powerful arguments for its continued success, while of course, keeping a very close eye on the risks that could pump the brakes.
All right, let's just jump right in. Look at this chart. This one visual pretty much tells the entire story of the bull case. We're talking about a leap from just over $250 million in revenue in 2021 to a projected nearly $2.8 billion by 2026. Folks, that is the literal definition of hypergrowth, and it's exactly why so many investors are sitting up and paying very close attention. So let's break this down. The first pillar of our bull case is all about that revenue engine. And I want to be clear, this isn't some fluke or a single lucky year. We're looking at a story of consistent, powerful growth that's actually building on itself year after year.
Let's put some real context to these numbers. Revenue almost doubled in 2022. Then it jumped another 66% in 2023. And if we look at the last 12 months of reported earnings, what analysts call the trailing 12 months, or TTM, they've already pulled in over $2.2 billion. The sheer speed here is just astounding, and it shows you how quickly they're capturing market share.
Now, what's really fascinating here is how they're pulling this off. It's not just one thing. They've got a growing subscriber base, up 21% from last year to almost 2.5 million people. Their subscription model is incredibly sticky, meaning customers sign up and they stay. Plus, they're getting way better at upselling, with a 50% jump in people choosing personalized plans. That pushes the average revenue per user up to a solid $80 a month. All of this is what gives them the confidence to guide for an ambitious $6.5 billion in revenue by 2030.
But listen, explosive growth is only half the story, right? For any of us looking at a long-term investment, the real question is, can they actually make money? For a long time, Hims was a classic Silicon Valley-style growth company. Spend, spend, spend to get customers. But as you're about to see, that whole narrative has done a complete 180.
And this slide right here, wow, this captures that transformation perfectly. Just a few short years ago, in 2021, the company was in the red by over $100 million. And now, they've completely turned it around, generating $134 million in actual profit over the last year. This isn't just a small step forward. It's a fundamental shift from a cash-burning machine to a cash-generating one.
And this didn't just happen by accident. It's the result of getting smarter and more efficient as they scale. Their gross margins, that's basically the profit they make on each sale before overhead, are now over 80%, which is just fantastic for this industry. They're also spending less on marketing to get each new dollar of revenue. But the real key here is that operating margin turning positive. That's a sign of what's called operating leverage, and it just means that as they get bigger, each new dollar of revenue becomes more and more profitable.
So we've seen the impressive internal story, amazing growth, and a clear path to profit. But for our third pillar, let's zoom out for a second. A great company in a dying market is still going to struggle, right? Well, Hims is doing the exact opposite. They are riding a massive, massive wave, the explosion of the telehealth industry.
To put this into perspective, the market they're playing in is already enormous. By 2025, global telehealth is expected to be a nearly $200 billion industry. And just 1 year after that, it's projected to leap to $244 billion. And if we look way out to 2032, we're talking about a market that's knocking on the door of $800 billion. Hims isn't just a ship. It's a ship sailing in a very, very strong current. And what's more, Hims is making some really smart moves to grab a big piece of this pie. By focusing on the massive U.S. market and controlling their own drug supply through compounding, they get a real edge on pricing and availability. Plus, they're jumping into super high-demand areas, like the new generation of GLP-1 weight loss drugs, all while looking to expand overseas. So we've seen the incredible growth, the newfound profitability, and the massive market tailwinds. It all looks pretty good, right? But what does Wall Street think? And probably more importantly, what are the potential roadblocks we need to consider to get a truly balanced picture? Overall, the analysts are feeling pretty positive. The general consensus rating is somewhere between a hold and a buy, with an average price target in the mid-40s. That suggests a pretty healthy 32% upside from its current valuation. You have some very optimistic high targets, while even the low targets suggest a fairly limited downside.
And this quote from a major firm like Morgan Stanley really sums up the professional sentiment. Now, a 2.5 to 1 risk-reward skew is a bit of analyst speak, but what it basically means is they believe the potential for this stock to go up is more than double the potential for it to go down from here. That's a really strong vote of confidence.
Okay, but what about the biggest argument from the bears? Isn't this stock just way too expensive after its huge run-up? Well, if you look at the numbers, it's surprisingly reasonable. Its forward PE ratio is around 32, and its PEG ratio, which is my favorite because it factors in the growth rate, is right around 1. For growth investors, a PEG ratio of 1 is often seen as the sweet spot, a sign of a fairly valued growth stock. So despite the surge, the numbers suggest the price really hasn't gotten ahead of the company's performance.
Of course, no investment is a sure thing, and it is absolutely crucial that we talk about the headwinds. Supply chain problems for key drugs could definitely hurt sales. The telehealth industry as a whole is always facing the threat of new regulations. And they're competing in a space that's attracting giants like Amazon. These are serious challenges you have to keep on your radar.
And here's our quick but very important reminder. This explainer is for educational purposes only. It is not financial or tax advice. Please always do your own deep dive research and consult with a professional before making any investment decisions.
So how can you use all this information? Well, here are a few guidelines for your own thinking. First, really analyze that growth story. Does that kind of trajectory fit your personal risk tolerance? Second, evaluate their path to making money. Are you convinced it's sustainable? Third, think about the broader market. Are you a long-term believer in this telehealth megatrend? And finally, always keep a close watch on those key risks.
So to wrap it all up, the core thesis of this explainer is this. HIMSS appears to be at a genuine inflection point. It's managed to combine that rare mix of explosive growth with real, sustainable profitability, all while riding the massive wave of a booming market. For investors with a long-term view, this could represent a very compelling opportunity to own what looks to be an emerging leader in its category.
Which leaves us with one final provocative question to think about. With such ambitious goals and such strong execution so far, are we actually watching the early chapters of one of the next great healthcare growth stories unfold right before our eyes? Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing. Please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities. We'd love to hear from you.